Welcome to Drill on Earnings. We have quarterly results from Intel. These are interesting results. This is a business story behind one stock on the move. I'm Cory Johnson, Chief Market Strategist for Epistrophy Capital Research. And Intel's earnings Q3 were better than Wall Street expected, I guess, at least in terms of revenues. Wall Street expected a 2-cent per share loss. Intel gave us not -2, not -4, not -10, not -$100, not -$2, not -$3, -$3.88 instead of the 2-cent loss, because there was a surprise, really big charge here. Let's look into the actual business, and then we'll look at the numbers as well. So the business had $13.3 billion in revenues. They sold a lot of chips in the quarter, and their foundry business was very busy in the quarter. In addition to selling chips, making chips was a good business for them. But revenues were down, again, down 6% on a year-over-year basis. And when we look a little bit deeper, so gross margins, not really happening. 15% gross margins, well below the numbers that Intel likes to hope for, near 30-40% or so, 15%, pretty weak for this company. And their R&D spending down to about 30% of revenues, but they still have to spend a lot of money to develop the future, even though the current days are really hurting them, as is the recent past. So let's talk about that write-off for a second. So the company took a just incredibly large write-off for impairing of some stuff that they bought. During the pandemic, they bought a ton of machinery to make chips for PCs, to machinery that's no longer good enough. And they finally just had to write it down. It was just not good enough for the current age and the future age of what chips are going to be required in PCs. And so the result was a $15.9 billion impairment, as well as $2.8 billion in restructuring. So this is a real problem for this company, just all of these paying for the mistakes of the recent past here. So we dig a little bit deeper into the business here. We'll look at how the business is kind of constructed. So 42% of revenues is client computing. That's making PCs. The data center business, only 19% of revenues. They'd like that to be bigger because there's a lot of profits there. But 25% in the foundry business. And boy, they lost a lot of money making chips for other companies. Almost $6 billion in losses in the quarter in the foundry business. It really hurts the overall results for Intel. So how did the stock react? Well, Wall Street kind of understood that the charges for writing down the equipment that they'd already had were non-cash charges. So I don't know, they didn't mind this so much. Intel's still holding on to the vision that the future a couple of years from now will be a lot better than they are right now. But so the stock was up 9% in after-hours trading, but for the year, down 41%, kind of painful for Intel. So one of the questions asked in the conference call that I thought was really interesting was an analyst querying Pat Gelsinger, the CEO, saying, okay, you've got this foundry business, you announced this deal to make some chips from Amazon. You said you're not going to give us any notion of how big the deal is going to be over time or when it's going to show up, but what will the metrics be? How will we know if the foundry business is doing better? What will you tell us when that day arrives? And could that be next year? Well, Pat Gelsinger said, next year, benefits from that Amazon deal or other deals? No. Here's what he had to say.
Clearly next year, there's not a lot of financial benefit from it, because we're only ramping late in the year. Thus, we'll be giving more qualitative metrics on progress as we go through the year. We'll continue to update, give LDV updates, lifetime deal value for foundry updates as we go through the year. And clearly, as we get more customers, we'll be updating on that progress. It has much larger impacts on 26 financials as we ramp and bring wafers home, as well as move into the better margin structure that we'll have on Panther Lake with 18A and across the product line. So we'll be giving clarity in that way, but it will be hard to tie it to specific financials next year. But this is super important for us, for our foundry business, for the industry. So we'll be giving plenty of color as we proceed.
So some of their cutting edge products, their Panther Lake products, their 18 angstrom chips, which would be the most cutting edge chips, the thinnest chips ever made, thinnest wafers ever made. That's where they will be in the future. They're not there yet, and and it looks like it's going to be at least 2026 until those financials show up to the benefit of Intel, if they show up indeed. I mean, I think that the write down of all the stuff that they bought in 2020, only 4 years later, makes you wonder if they're going to know what the future is going to be 2 years from now. All right, so that's your big story in the drill down. So what's our drill down earnings takeaway on Intel? What do you want to remember about this quarter? So Intel third quarter, what you want to know, $13.3 billion in revenues, That sticks in your head, as does the $3.88 loss, the massive, massive write-off that they had of nearly $16 billion in equipment that they could no longer use and just writing off the books. And I think the one number to remember here is $5.8 billion this quarter in the foundry business. That's how much they lost in foundry this quarter. So growing in the foundry business is very painful for Intel. All right, thanks for checking out Drill Down Earnings. I'm Cory Johnson.